Equity Market Update, April 2023. Indian equities registered a strong rebound in April 2023, and Nifty 50 and S&P BSE Sensex ended the month higher by 4.1% and 3.6% respectively. The key market impacting events during the month includes unexpected pause by RBI, announcement of cut in oil production by OPEC, better than expected growth in China, IMF revising down India's growth forecast and expectation of normal monsoon by IMD. Mid-caps and small caps outperformed large caps during the month. The month saw broad-based improvement in returns across most major sectors except IT. Auto, capital goods, banking, healthcare and metal were the key outperforming sectors, while IT underperformed. Most major global equity indices ended the month in positive, with Europe and Japan outperforming US. Hang Seng and MSCI Emerging Market Index ended the month with negative returns. FPIs bought equities worth $1.4 billion in April 2023, but have cumulatively sold equities worth $1.8 billion in 4 months CY23. On the other hand, DIIs bought equity worth $0.3 billion in April 2023 and have cumulatively bought $10.4 billion approximately in 4 months CYTD23. Of the Q4 FY23 results, earnings of private banks were better than expected, and that of cement, oil and gas, consumer staples and auto were largely in line with expectations. Earnings of IT, consumer durables and chemicals were lower than expected. Outlook: as on April 30th, 2023, Nifty 50 was trading at around 17x FY25 E price to earnings multiple. The valuation multiples have moderated from their recent peak and are now close to their historical averages. India's market cap to GDP stood at around 81% based on CY24 GDP estimates, off its peak and within the historical range of past decade of 70 to 100%. The gap between 10-year GSEC yield and 1-year forward Nifty 50 earnings yield has also narrowed from its peak. Thus, while market valuations are still above historical average but have corrected from their peak. Further, one should view these valuations in the context of structurally attractive nominal GDP growth, a robust economic recovery, a healthy corporate earnings outlook and strong delevered corporate balance sheets. Notably, while small cap have outperformed significantly over the past 3 years, partly due to favorable base, it has significantly underperformed large caps and mid caps in the past 1 year and also over past 5 years. While there is uncertainty regarding the near-term outlook, we remain positive on equities over the medium to long term, considering the resilient domestic growth outlook, robust corporate profitability, and growth-supportive policies. Further, post the corrections in small caps over the past year, valuations are close to historical averages. Hence, one may consider increasing equity allocation towards small caps funds in line with individual risk appetite and with a medium to long-term time. Accelerated monetary policy tightening, a sharp slowdown in global growth, persistent inflation, a slowdown in earnings growth and a delay in recovery in the rural sector are key near-term risks. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.